Welcome back to the Trader Wall. In today's video, we're going to dive into the most dangerous mistakes new traders make and how to avoid them. By the end of this video, you'll have a better understanding of how to protect your capital, develop a solid strategy, and ultimately set yourself up for long-term success in the trading world. So bring your notebook and take notes from all of these. Let's get started. Lack of education. Jumping in without proper knowledge. One of the most dangerous mistakes new traders make is diving into the markets without understanding the fundamentals of trading. Trading involves much more than simply guessing where prices will go. If you don't have a solid grasp on concepts like technical analysis, risk management, and market behavior, you're setting yourself up for failure. Lack of education leads to impulsive decisions, lack of consistency, and unnecessary losses. Key takeaway. Before you start trading with real money, invest time in educating yourself about the markets and the tools you'll need to succeed. Poor risk management. Taking profits too early and letting losses linger. Risk management is the backbone of successful trading. Many new traders make the mistake of closing winning positions too early while letting losing positions run longer than necessary. This can quickly erode your account balance. The key is setting stop-loss orders to protect against large losses and having clear exit strategies to lock in profits when the market moves in your favor. A good rule of thumb is to never risk more than 2% of your trading capital on a single trade. Key takeaway. Learn to control your risk and cut losses early to protect your capital. Oversized positions. Betting too much on one trade. When you're starting out, it's easy to get carried away and risk too much on a single trade. Taking oversized positions can quickly wipe out your account if things go wrong. Trading is a marathon, not a sprint. Rather than aiming for massive returns in one trade, focus on consistent, smaller gains over time. Key takeaway. Always size your positions in relation to your account balance and risk tolerance. Ego-driven trading. Letting emotions cloud your judgment. Ego-driven trading happens when traders let their emotions, pride, fear, or frustration affect their decision-making. You might hold on to a losing trade because you don't want to admit you're wrong, or double down on a trade to try and prove yourself right. This can lead to bigger losses and unnecessary risks. Key takeaway. Keep your emotions in check. Stay disciplined and always stick to your strategy regardless of how it feels. Impulsive trading. Acting without a clear plan. Many new traders fall into the trap of making spontaneous trades without a clear plan. They might see a headline or hear a tip and jump into a trade without proper research. This kind of impulsive trading can lead to unnecessary risk and unpredictable outcomes. Always plan your trades ahead of time and trade according to a defined strategy. Key takeaway. Trade with a clear plan and strategy, not based on gut feelings or rumors. Inconsistent trading style moves. Constantly switching strategies. One common mistake is switching strategies too frequently. If you're constantly changing your approach, you're never giving one strategy enough time to prove itself. Inconsistent trading can lead to a lack of focus and unnecessary confusion, which will harm your long-term results. Whether you prefer day trading, swing trading, or long-term investing, it's crucial to stick with one approach and improve it over time. Key takeaway. Stick to a trading style and strategy for a reasonable period before making changes. Greed. Letting greed take over your decision-making. Greed is a powerful emotion in trading, and it often leads to poor decisions. The desire for larger profits can push traders to take on more risk than they can handle, or hold on to positions too long in hopes of a bigger payoff. This can quickly turn a good trade into a bad one. Key takeaway. Always stick to your predetermined risk-reward ratios and don't let greed push you to take unnecessary risks. Blindly following gurus. Relying on others without critical thinking. It's easy to get caught up in the hype of so-called guru traders who promise massive returns. Following these individuals without thinking critically can lead to significant losses. While it's okay to learn from others, you should never blindly follow someone else's strategy without understanding it yourself. Always do your own research and make decisions based on your personal analysis. Key takeaway. Learn from others, but make your own decisions. Conclusion: avoiding these mistakes and learning from the experiences of others is crucial for becoming a successful trader. Take your time to educate yourself, develop a clear strategy, and maintain discipline in every trade you make. By managing your emotions, sticking to your plan, and continually improving, you'll be well on your way to trading success. If you found these tips helpful, don't forget to hit that like button and subscribe for more valuable content like this. Remember, trading is all about managing risk, staying disciplined, and continuously learning. Avoid these common mistakes, and you'll be on the right path toward becoming a more confident and successful trader. If you have any questions or want to share your own experiences, leave a comment below. I'd love to hear from you. Keep learning, stay focused, and happy trading.